Gold hits a record above $4,500 an ounce. Silver and platinum climb to all-time peaks. Frictions between the US and Venezuela rub the haven shine onto precious metals. Hopes of more Fed rate cuts next year also adding to the luster. Live from Sydney, I'm Paul Allen. It is the last day of the year for our programming. This is Insight. We're going to dive deeper into the stories that matter with crucial context and sharp analysis. While Asian stocks climb after tech stocks led Wall Street to a record. FX markets are in focus as the yuan hits a 14-month high and South Korea warns on excessive won weakness. Washington holds off on new tariffs on Chinese chips even after accusing Beijing of unfair trade practices. Javelin Wealth Management's Polka Mishra and AXA investment managers Ecaterina Bigos will give us their outlook for markets in the next year. China's battery powerhouse CATL dominates its home turf and is eyeing global markets. But European politics and Donald Trump could short-circuit its expansion plans. Our panel weighs the impact on costs, capacity and competition in the EV space. We're joined by Bill Russo of Automobility and Yun Mei from China Great Wall Securities. All right, let's take a look at how markets are tracking at the moment. Gold, once again, the story of the hour. It has pushed through that psychologically important $4,500 level, although it has slipped back a little bit since then. But silver continuing its incredible rally, even outshining gold, now closing in on $72 an ounce. Elsewhere around equities markets, it's a bit of a mixed bag to close out the year. That Santa Claus rally just losing a little bit of steam. Here in Australia, the ASX are due to close pretty soon for a shortened holiday trading session, off by about 0.4%. Elsewhere around the region, seeing modest gains. The Kospi better by 0.1%. We also have crude prices feeling a little bit of pressure compared to what we're used to seeing, but those geopolitical tensions still keeping prices elevated. Looks like crude is going to hold on to 5 consecutive days of gains. Well, the strong US GDP print coupled with a drop in volatility seems enough for investors to drive stocks to new records. This chart shows implied correlation also collapsing, helping fuel the rally. Let's get the market outlook with Bloomberg MLive strategist Mark Cranfield now. So, Mark, kind of interesting, really, that we're seeing US equities going higher, even after that really strong US GDP print. Is that really moving the needle at all in terms of rate cut expectations? The market clearly doesn't seem to think so.
Well, the equity traders seem to have got the perfect scenario from their point of view. They've got an American economy which is doing even better than was expected, and yet there's enough in the other data that was released as well, like the confidence numbers, for example. There's enough question marks there to suggest that the Federal Reserve is still justified in lowering interest rates again as we get into next year, and traders are still pricing in 2 interest rate cuts in 2026. So what more could equity investors ask for, really? They've got a strong economy, the chance for lower interest rates next year. That's really an ideal scenario as they go into year end to keep the rally going. Plus, we've got this promise that there could easily be a couple of jumbo IPOs when we get into the first quarter of next year. We've still got OpenAI and SpaceX both moving towards what could be very significant new issues at very high multiples, and that's helping to keep people in a very good mood about US equities.
And how about the tech story? Can we see that rally continuing to roll on into 2026?
Well, that's very much related to the AI theme and towards these potential huge IPOs and the valuations which are currently being implied from the way that these companies are doing their refunding in the private market. These numbers are so incredible. That's helping to fuel even more demand for the existing tech stocks, because by comparison, even though the multiples still look pretty good at the moment, they're not as extreme as some of the numbers being suggested for people like OpenAI. So relative basis, they don't look so bad. So that's helping to keep everything going from that point of view. So yes, there's no particular reason, given those conditions, given the economic growth as well, and the hands-off approach from the US administration, all of that coming together looks pretty good for tech stocks.
And how about the picture for gold? Because it did briefly break through that $4,500 level, as I mentioned a moment ago. We're now back below that. Does this rally still have legs, or is the peak in?
Well, you've got a lovely situation here for precious metals, where on the one side the US dollar is weaker, which is always good for the metals space. You've got prospect of lower interest rates in the United States. Those two together are exactly what you need as a precious metals investor. Plus, you've got the uncertainty around things like Venezuela, the US, the friction there between US administration and what they're doing with Venezuela. That's pretty worrying. People would want to hedge by using gold. Plus, Ukraine, Russia, still unresolved. No truce there going in that direction. So all of these things together give you reasons to use gold as a hedge against geopolitics. Plus, you've got dollar and the rate situation moving in your favor as well. It's, again, a very good scenario for people that like the precious metals space.
All right, Bloomberg MLive strategist Mark Cranfield there. Just got some breaking news for you about BP. Wall Street Journal is reporting that BP is nearing the sale of a majority stake in its Castrol lubricants business. This is according to people familiar with the matter. That sale would be to the investment firm Stonepeak. It would value the entire division at $10 billion. That includes debt as well. So the details as we know them so far, under that deal, BP would be set to receive about $6 billion in proceeds from the sale of a 65% stake of that business to Stonepeak. So we'll get you more details on that as we get them. That reporting from the Wall Street Journal. Well, let's get a little bit more on markets now with Polka Mishra, partner at Javelin Wealth Management. Polka, as we head into the final trading days of the year, we're seeing that rally on the S&P and other markets as well, just continuing to roll on. Do you see this rally extending into the new year, and what's your price target for the S&P next year?
Yes, Paul, we don't particularly put price targets as such. We're very long-term investors, but we expect the momentum to roll through into 2026. We don't expect it to be very different from how 2025 went. There's a lot more upside in the equities space, as we just spoke about it, gold, etc. Everything should be fine, at least for the first half of the year. We do expect the year to remain volatile, as was 2025, because there's so much news, geopolitics, so many events to happen, and then we have the US midterms, which will induce some more volatility in the market. So we're fairly positive, at least till the first half of the year 2026.
Well, as Mark was outlining there's a couple of giant IPOs coming as well. Still a fair bit of enthusiasm about the AI trade also. But where do you stand on the is AI a bubble, is it not debate?
So I think it was 2 days back we were talking to one of the experts who said it's a bubble that you can't afford to be out of. So we think there's still leg in the rally. There is a lot of investment that is going in. It's not without risks. So it's a question of where you invest. Next year is going to be a bit harder to make your selections because the space is becoming a bit more dispersed with more players coming in. So whether it is US, whether it is China, whether it is chip makers. So it depends on your risk appetite, what you want to select, but it's very hard to sit out this space right now. So we remain bullish. We like still the large tech companies simply because they've got such big balance sheets that they can absorb the time that is needed for returns to come through. We also think that infrastructure plays are a much better value at this point. Power infrastructure is still a bottleneck, so you can look at that. Mark talked about some IPOs in US, but we are also seeing IPOs coming in Hong Kong. So there's a lot more development in China. We heard about the chip development. I think it was more threads yesterday. There's a lot more advancement there. So we continue to be bullish in the sector, cautiously bullish.
Yeah, so as you mentioned there, you do have an eye to the longer term. So with that in mind, is the AI infrastructure your favoured long-term allocation, or are there other sectors of the market that are unappreciated at the moment that you're looking at?
Within tech, of course, AI infrastructure is what we like. We like the chip manufacturing space as well, the whole semiconductor supply chain. But beyond that, I think, apart from that, we do more geographic allocations rather than sector allocations. So it's more things like emerging markets, Asia, as opposed to sectors in these markets. China, of course, is more of an alpha play. India, we take it as a beta play.
Well, I want to talk to you a little bit more about your Asia allocations when we come back a bit later. But just playing into the broader theme in the rally that we're seeing, also helping underpin this is, of course, the expectation that we get a couple more rate cuts from the Fed next year. But then you look at something like the very strong third quarter GDP data that we just got, bearing in mind inflation still sticky in the US. Does this look like an economy that needs the support of rate cuts right now?
In all honesty, we did not think the economy needed the last rate cut as well. U.S. economy has been resilient. It's continued to be strong. The concern has been around the labor market. Now, we talked, Scott Bessent was mentioning that should U.S. base inflation rate be higher than the 2%, and that's coming into question now. We fundamentally don't think the economy needs the rate cuts, barring what needs to be done in the labor market. Now, the question around the labor market is a bit more complicated. Do the old tools work in today's world where job losses have started to happen because of AI productivity? So is it the Fed's job now, or something else needs to be done to address the weakening or softening labor market? But we are factoring 2 rate cuts more because it's not what probably should happen, but what we think will happen. We heard Donald Trump talking about selecting a Fed chair who will do rate cuts. So there's a question mark around how much pressure there will be on Fed. So we're factoring in those rate cuts because of that. And that actually flows into the biggest risk that we are concerned about, especially in the US, is if inflation picks up again. It's kind of reminding you of the Nixon scenario where you get pressured into cutting rates and then it's hard to control inflation after that.
Obviously, it has implications for the US dollar as well, and there's some conflicting opinions here. I mean, we have a chart on the Bloomberg terminal that suggests, the technicals suggest there could be some upside ahead for the US dollar, but a lot of the guests we speak to expect we're going to see some downside potentially into next year as well. So where do you stand on dollar outlook?
So for us, it's the same as the rest of your guests. We do expect dollar weakening to continue, gradual dollar weakening to continue. If you look at the other central banks, the rate cut cycle is over for most of them. A lot of them are looking to tighten the rates, whether it is going to be UK, Australia, maybe New Zealand. And Japan is already tightening. So we think dollar weakness will continue, and which is good for the Asian economies because there's less impact on the Asian currencies. Dollar strengthening changes a lot next year. If that happens, it's going to impact Asia a lot more than the US.
All right, Polka Mishra, partner at Javelin Wealth Management, is sticking around. We can talk a little bit about how those US dollar calls feature in terms of expectations for Asia and Asia emerging markets as well. Still to come this hour, the US holds off on new tariffs on China chips. For now, we'll have the details next. This is Bloomberg. Welcome back. You're watching Insight. The US is holding off on new Chinese chip tariffs until at least mid-2027. Now, that's despite accusing Beijing of engaging in unfair trade practices in the semiconductor sector. Let's bring in our China correspondent, Min Lo in Hong Kong. So, Min, tell us more about this investigation into Chinese chips. What does the US mean by unfair trade practices?
Yeah, this has been a long time in the making. This probe was started in the last few weeks of the former President Joe Biden's administration. It was a probe into legacy chips produced by China. So these are chips that are not necessarily used in AI, but they're used in many different industries, from medical devices to airplanes to autos to telecommunications. And the U.S. Trade Representative Office says that they have found that China has aggressively and sweepingly used non-market policies to create foreign dependence on its products in a way that was disadvantageous for U.S. commerce. And its decision is to impose no tariffs for the next 18 months, but starting from June of 2027, they will impose tariffs, and the rates will be announced at least a month before then. So this is a clear signal that President Trump is trying to stabilize relations with China and at least maintain that trade truce that was reached when the two presidents met in South Korea in October, but still leaving himself that opening 1.5 years down to have a bargaining chip when the time comes for U.S. and China to renegotiate the extension of this trade truce.
And how has China responded to this?
Oh, no surprise that China is not happy about that. We have the Chinese embassy in Washington saying that they are opposed to what it calls the abuse of tariffs, and that China will take all necessary measures to protect its legitimate rights and interests. But given that the U.S. is not imposing tariffs immediately, it is probably unlikely that China will retaliate in a significant way in the near term. But meanwhile, of course, the U.S. yesterday had announced a ban on drones as well, on foreign drones and drone parts. And China has responded to that, hitting back and calling on the U.S. to withdraw that particular new rule, and saying that, again, China will reserve the right to take actions to protect or safeguard the rights of Chinese companies, and is accusing the U.S. of bullying Chinese companies.
All right, Bloomberg's China correspondent Min Min Lo there. Let's get back now to Polka Mishra, who has stayed with us, partner at Javelin Wealth Management. Polka, I just want to pick up on what Min Min was saying there. There seems to be this uneasy détente between the US and China on trade. The US still accusing China of unfair trade practices, but no retaliation for now. How do you see the relationship between these two evolving next year?
Paul, this relationship has remained volatile for a while, and we don't see that changing. I think there's a little more practicality that's come in after the first round of tariffs and escalations. I think the U.S. administration has also recognized that China is not going to back down as easily, and both are extremely big trade partners. They have huge dependencies on each other. So there'll be elements of posturing and newsworthy items that will come through, but slowly we're seeing more and more both of them trying to figure out how they can work together while managing the politics on the side.
Now, we were talking a few minutes ago about how your expectation going forward is for dollar weakness, and going along with that, we're seeing some strength in the Chinese yuan at the moment. No panic on markets due to this, though. I'm wondering, what's your allocation to China at the moment, and considering the currency pair, what are you looking at here?
So, yes, we are allocated to China. With regards to the currency first, Paul, I think the fixings have been done in order to avoid any sort of large carry trade building. It is to prevent the traders from hoarding US dollars. So, and if you look at the numbers, it's around a 2.6% differential, and I think yuan strengthened around 3% last year. So I think that's going to continue to be managed. If rate cuts happen in US as they are anticipated next year, we'll see lesser strengthening in yuan, so it'll be a bit range bound next year. From our allocation in China perspective, that's why currency is not as big a consideration for us. On the equities side, we overall like the broad China market per se. We're concerned about the domestic situation. So the sectors, of course, tech, advanced industrials. We still think allocations to EV, despite price pressure, is logical. For very long-term investors who have the patient capital, I think having some allocation to the consumer space for that big upside that can come through in later, probably not next year, later next year or the year after, that's a pocket that is really undervalued right now for the right reasons, but with the effort that the Chinese government is looking to potent in driving consumption that can benefit in slightly later future.
Yeah, that's an interesting call, the consumer space, because, as you rightly point out, it's very beaten up right now because the prospects for consumers so closely tied to the property market, which has been circling the drain for so long now. Does your optimism about consumer discretionary translate at all about optimism that this property crisis eventually gets sorted out?
No, unfortunately, we don't see an end to that. We haven't seen any clear effort being made to resolve that, and whatever efforts have been made are limited, and they've not had any significant impact. On the consumer side, though, we've seen some genuine effort coming from the administration, whether it is funding the state governments, subsidies, etc. So that's where we feel that there is value to unlock. If you look at it, the savings rates of Chinese consumers is very, very high. So there is potential to unlock. And in the meeting, I think earlier this year, they finally emphasized on driving consumption as the priority for next year. The reason why we've gone back into China is that in the last year and a half, what we've seen is that the policy making has been more deliberate, and we've seen follow through on those policies. So when the government says that, okay, now driving consumption has become a priority, we expect concrete steps to be taken on that, and that's where the unlocking of that large Chinese consumer can come through, and the savings can come into the market and propel the economy further. But valuations are still attractive either ways.
Well, one of the other big markets that you like in Asia is India as well, but it's seen billions in foreign capital outflows accelerating in the final quarter of the year. Is it a good buying opportunity, though, considering the growth story longer term?
Yes, we think so. We like the fundamental story of India. So when you're doing your portfolio allocation, you have to have different stories there. So Japan and Korea for us are the reform turnaround stories. China is a recovery story as well as a AI play. And India is the long-term fundamental, strong fiscal positioning, steady policy making. It's lost out on the rally this year because the rally was a little more driven by AI space, where, of course, India does not have the leadership. It's got some of its own problems, but where it is in its development cycle, it has a role to play in the portfolio. So we've allocated separately both to India, China, and we have Japan as well in our portfolios, Paul.
Well, it's been a very calm year for Indian markets, and that's us being polite. What needs to happen to put a catalyst under equities?
One, of course, from an investor allocation perspective, especially foreign money coming in, there needs to be a resolution to the tariff situation with the U.S. There were instances where we figured that there will be some resolution, but it's not happened yet. And for foreign investors, that's a key taking point, and that's why you've seen a lot more outflows. India is still part of that emerging market allocation or Asia allocation in portfolios, so that money goes out from India and goes to China. So that's number one. From a more fundamental perspective, the growth is still driven by government spending. We are still not seeing private investments coming through. So those reforms need to come through for that growth story to develop.
Okay. All right, Polka Mishra, we're out of time, unfortunately, but thanks for joining us. Polka is partner at Javelin Wealth Management. Now, we've got some live pictures for you out of India. In fact, you're seeing Sriharikota, where we are expecting the Indian Space Research Organisation, ISRO, to launch the AST Space Mobile Satellite to low Earth orbit. We're waiting on that launch. We'll bring you the pictures when we get them. This is Bloomberg. Welcome back. You're watching Insight. Ford Motor recently announced that it's dialing back its electric vehicle ambitions, but it's not stepping away from the energy transition. Instead, the automaker is betting big on a new business line, producing batteries for energy storage. Now, the move leverages Ford's partnership with China's CATL, aiming to build larger-scale batteries designed for stationary storage. So, we'd be thinking power grids and data centres here. And this is part of a broader trend in North America where battery makers are shifting focus away from EVs and towards applications that keep critical infrastructure running. Focusing on CATL, its technology-powered 1 in 3 cars sold this year. This is according to data from South Korea-based SNE Research. But as growth slows in China, CATL is now looking abroad to boost its business. That, however, could face some big roadblocks. Bloomberg's Asia transport reporter Linda Liu joins us now for more on today's Big Take. So, Linda, tell us more about CATL's plans here and what's at stake.
So CATL is really pushing into the European market. It's built 2 factories in Germany and Hungary, and now it's building the 3rd one in Spain, and that's in partnership with Stellantis. So you can see that they're investing heavily into localizing production in Europe, where it's going to be a big market for EVs. But similarly, it's facing an uneven demand for electric cars because the continent has really scaled back its goal to phase out combustion engine vehicles in the near future. And you're also seeing the support for EV purchase incentives kind of being pulled back. So demand is one factor. The other challenge is also the lower efficiencies and higher costs of producing batteries in Europe. That's led to some customers in Europe actually asking CATL to still supply them with batteries that's made in China. So CATL really has a balancing act on its hands.
Yeah, what is CATL's approach to Europe at the moment, considering the obvious risks that you just described with localizing production there?
Yes, so much investments have gone into these factories in Europe. In fact, CATL did a blockbuster share sale this year, raising some $5 billion to really fund this expansion. And really, with so much investments on the line, it's hard to tell the time that's going to take to pay off these initial capital outlays. Because, as we've said, demand is uneven and the production ramp-up is going to take some time as CATL needs to iron out these production issues that it's experiencing in Europe compared to its home market, where it's really kind of perfected battery production through its decades of experience. So that's something we're going to keep a close watch on, how CATL can really overcome these maybe efficiency and cost challenges for Europe and eventually kind of secure the orders that's going to help it gain a foothold in the European markets.
All right, Bloomberg's Asia transport reporter Linda Liu there in Hong Kong. Now, we spoke to CATL earlier, and the company told Bloomberg that it was making overseas expansions its top priority amid intense domestic competition. Its chief manufacturing officer, Ni Jun, spoke with Stephen Engel at the World Economic Forum in Tianjin earlier this year.
Irrational competition, I will call. Everyone, the industry-wide and the government knew this is a problem, this is unhealthy, this will destroy the industry. So there's a lot of a sentiment to come up with a regulation, a policy to prohibit this kind of price war. Mm-hmm. And as a result, that also forced everybody to dig in. Can you further improve your internal efficiency and so maintain reasonable business margin to survive, to continue innovate? So as for that part, I expect they will.
How are you doing that? How are you improving your efficiencies?
We are trying to do everything, improve the production utilization.
How is AI employed?
AI has been used. Actually, CATL has been embracing the AI revolution maybe 7-8 years ago. At that time, it already started from simple repetitive task and manual work. They try to use AI to capture, to do more efficient work. And now we not only using AI to screen the material, because of different material, different chemistry, and also different design, and also during the stage of manufacturing, and also after the sales. So AI has been utilized to improve, make sure the process is stable, is under control.
Over the next 5 to 10 years, what would your ideal next generation super battery factory look like?
Well, I would say in the next 5 years, ideally, let's take on all the trade barrier, all the consideration. Ideally, it should be green, number one, because we want to save our planet. The factory, we actually already do extensive improvement. We reduce our energy consumption, reduce any of the emission, and circulate any of the waste material will be recirculated into our production. That is the number one. Number two, it should be smart so that any human labor-intensive, dangerous task should be taken care by machines, by robots, by computers. So that's what we are saying. Also should be reconfigurable, because when you put that production, this is a capital-intensive facility. Yeah. When you put that production line, you don't want to see, after a year, the product, the end product, our customers' vehicle don't sell well. They say, we would like to switch that to a different vehicle. Right. Can you quickly, flexibly adjust, adapt to the new product? So that's our effort. We try to make it as user-friendly as possible.
How do you avoid the pitfalls of overcapacity that has affected the solar industry right now? Mm-hmm. And a lot of people in the industry are fearing that maybe there's going to be a battery overcapacity in the coming years. How do you feel about that?
Well, we don't look at that. We believe when the global community going to green, sustainable world, and there's a surge, the demand is drastically increasing. The key is a high-quality battery. Of course, you can. If you don't put a high standard, you can put a cheap battery. That capacity maybe is plentiful, but the consumer and our basically world-class OEMs in car industry, in energy company, they demand a high-quality, safe, and a long-life battery. For that, there's a shortage. Otherwise, we will not go to many parts of the world to make those high-quality batteries.
Would you say going overseas now because of the high demand?
That's
well,
right.
There's obviously, I wouldn't say the market is saturated in China yet, but there's a price war, obviously, which is brutal. Mm-hmm. Would you say, though, that your number one priority is kind of figuring out the international expansion?
That's right.
The best, I guess, algorithm for making it work. Mm-hmm. Is that your number one priority?
Yes.
That's CATL's Chief Manufacturing Officer Ni Jun speaking exclusively with Bloomberg's Stephen Engel back in June. So will 2026 be the year that the electric vehicle officially takes over our driveways? With automakers dropping prices, new battery tech hitting the mainstream, and a massive expansion of charging infrastructure, the industry is bracing for a tipping point. Let's get some more insights from our next guests. Bill Russo is founder and CEO at consulting and investment advisory firm Automobility, and Yun Mei is EV and lithium-ion battery analyst at China Great Wall Securities. Bill and Yun Mei, thank you so much for joining us today. And Bill, I'd like just to start with you to give us an overall sense of how you see the outlook for EV sales globally in 2026, particularly as we see some of the incentives starting to get scaled back.
Yes, thank you for having me. China is a very different. We see a very divergent paths here between China and the rest of the world. China is focusing on shifting from really a policy-led startup period to more of a market-led scaling period, and that's happened over time by making the electric vehicle affordable, de-risking consumer purchase consideration by making an even more affordable value proposition. And they've done that by scaling the critical technologies. EVs are, after all, battery powered. They're filled with electronics, and leveraging the supply chain that China has to scale those technologies has been its competitive advantage. Consumers now don't need to be convinced to buy an EV. More than 50% of the purchases of vehicles this year, passenger vehicles in China, are electric vehicles. There's no real concern over range or infrastructure. There's lots of investment that has been made in building infrastructure for charging electric vehicles. So it's moved into a more normalization period. And yes, it's a very hyper-competitive market, and it's a race to scale, and companies have to compete on price. The rest of the world is in a very different place, where consumers are still faced with EVs that are less affordable, and therefore the growth rates are much lower. But China is focusing on going global in a big way in order to recover the growth that they need to have in order to grow profitably.
Yeah, the affordability question is an interesting one, Bill. The price war in China, how has that reshaped expectations for affordability in the rest of the world? And do you see prices coming down in other markets?
Well, first of all, I think it's a race to scale in China, and that means you have to be able to survive the ability to scale the critical technologies. You either have to be able to build them yourself, as BYD does, or you need to access through supply chain partnerships companies like CATL, who have the ability to build large numbers of mostly lithium-ion battery configurations, which are the affordable alternative. And you have to be willing to sacrifice in a market like China, which has not grown over an 8-year period in the aggregate. The way that the EVs have scaled is at the expense of the combustion engine vehicles. And there's only a handful of companies that are able to do that and still make money. And that's going to be the consolidation criteria, your ability to scale the key technologies needed to differentiate your product from an affordability standpoint. And that's why China's ahead in the race. It has the ability to do that. And the rest of the world, lacking China, really does not have the equivalent of that supply chain.
Yun Mei, I want to bring you in here. Bill's talking there about the race to scale in China. I'm wondering, when you look at the EV landscape in China, what are you seeing in terms of the intensity of the competition? And do you anticipate any more consolidation?
Of course, we would like to see more consolidation, and at the same time, we also expect to see a K-shaped market in the coming 2026. As we all know, the financial incentives from the government for the EV will be not that much for the next year, and also that AI centers are fighting for electricity with EV. And nowadays, we can heard news like the automakers, they are worried that the battery companies, they prefer to provide the battery, the LFP battery to the ESS much more than the power battery, because at this stage, the ESS is more profitable. So next year, I think it's a very different year for China's market. Unlike past 3 years, when EV is still a big fancy things for Chinese people, and back then the penetration rate is under 50%, but nowadays the penetration rate is above 50%. So there's no reason for the government to continue their massive financial incentives project for that part. So just like you mentioned that the consolidation part might be some traditional factories will be bigger because they can keep their profitable ability, like the gross margin rate around 15%. And for the startups, which if they still could not make money in 2026, I think it's very hard for them. And I agree with that conclusion. The consolidation trend is continuing.
And you I know you also can see Tesla as being one of those companies responsible for helping fuel all this price competition in China. How do you see Tesla remaining competitive in the Chinese market?
I think nowadays there's huge advantages for Tesla this year. We can see slowly the market share for Tesla is increasing in China market for mainly 2 reasons. The first reason is that it creates some special model like Model YL, which is suitable for Chinese big family. It's bigger, but it's still Model Y, a very professional and traditional model in China. And so we comes for the second reason, that the safety reason. Though it's the intelligent driving is very popular in China, but nowadays the safety concern, so many accidents happens. Last year is a tragedy, so nowadays the consumers pay so much attention to the safety part, and that's why CATL got its popularity, because when consumer they want to buy a car nowadays, they are not like they were like 3 years ago. Nowadays the consumers will ask the sales, what is the battery in that car? So CATL is the best choice, and EVE and Goshen, and also the other famous brand. If the battery comes from Novel, the clients may feel very worried about that. So this is another reason that Tesla is getting better in China.
Bill, I want to get your view on Tesla as well, and how you see its strategy evolving in some of its key markets, particularly around pricing. And when might we see a compact EV, both becoming more widely available and affordable, not just from Tesla, but from some of its competitors as well?
Well, Tesla's performance in China, obviously they're faced with a much more hyper-competitive market here, right? They have a lot more competition here than they have anywhere else. And therefore, they have to keep up at the speed at which Chinese companies are able to, A, scale their supply chains, which is one of the reasons why they're here. They are working with CATL in using their LFP batteries for their more affordable product configurations. And it is a race to affordability. Tesla also has a technology value proposition. They're the pioneer in this space, and they're claiming a lead in self-driving technologies, although Chinese companies are very fast in their ability to test, validate, and deploy these technologies. Actually, one of the challenges that Tesla is facing is they don't have this entry-level price point covered, which gives exposure in the market to more affordable alternatives than Tesla. Tesla's price in China is above $30,000 US equivalent. There are Chinese brands that can sell at 1/3 that price, including companies like BYD. Xiaomi's very popular models are right on top of Tesla on price and are selling at a higher rate now. Xiaomi is one of the top-selling brands now in China. So I think Tesla's faced with a lot of competition, and I think Tesla's challenge is not only cost, but also speed. They've not launched a new model. Yes, they've refreshed and they've stretched the wheelbase on the Model Y, but they haven't launched a new model in China in 5 years. So I think that's going to be their biggest challenge. As Chinese companies go global, they're going to take very competitive products at very competitive prices and challenge Tesla directly in most of their core markets, perhaps outside of the United States.
Bill, you mentioned Xiaomi there, and it's an interesting story in terms of the EV context, because what is it telling us about trends around convergence and transport to consumer electronics and software as well?
It says in China, where virtually every person is a smart device user, more than 1 billion people use smart devices in China. The ability to integrate a car that has the intelligent connectivity features that a ubiquitously connected market expects in a technology product. In fact, if you're going to climb above the commodity hardware, you need to differentiate your product as an EV in technology. And the most obvious way to do that is with a user interface that's software defined, that allows a consumer to be connected during their mobility lifestyle. And Chinese brands really are very good at that. And that's how they're getting the margin. The companies like Xiaomi, shown here, are delivering a product that rivals a smartphone with its richness in software features that really complements the connected lifestyle that they have. And they are able to compete at a much higher price point because they have a technology value proposition. If you're going to compete at a higher margin, at the higher price point, you need to have a technology point of differentiation. And Xiaomi has that.
You and May, we've just got a couple of minutes left, but I'd like to get your analysis of where we stand in terms of battery and lithium-ion battery as well. We were talking a little bit earlier about CATL. I mean, it's pursuing construction of factories in Europe, also battery swap technology. What's your opinion of some of these strategies that CATL is pursuing here?
I think it's very clear that CATL valued the most profitable market in the world, like in Europe. The German factory went very well. The gross margin there is around 30%, much higher than its gross margin in China. So nowadays, not only the energy storage part needed the battery, also the European automakers, they needed the power battery. Even though the EU, they changed their 2035 target recently, I think they will keep the transformation part, and they still need power batteries with reliable and massive production, and I think CATL can be their good partners.
What are the main roadblocks that CATL is going to face in their global ambitions? Is perhaps US tariffs one of them?
Of course, the tariff is a huge problem, but luckily we see Ford, it's the second time Ford tried to work with CATL, and hopefully this time the problem will be solved, and nowadays it's very unstable to say what the President will decide to do next for the American part. We're waiting for more good news, actually, and we will try, because it's good news that Ford tried to negotiate with CATL years ago, so we already have a master plan, and today the ESS plan will be based on the premier plan, so it will be
Yeah, we're out of time, unfortunately, but Yu Mei of China Great Wall Securities and Bill Russo of Automobility, thank you both for joining us today. We have more ahead. This is Bloomberg.
Yes, I think that 2026 is the time that we're going to see very different paths. It won't be the one that we have seen in the past 3 years.
The House is up for grabs, the whole thing. I think there's going to be a lot of chaos and commotion around new candidates, current candidates. That's going to create some short-term kind of angst in the market. So I suspect, again, that we're going to see the market pull back in the first half of the year. And that's going to lead me to want to be more cautious.
The amplitude is getting greater and greater, which suggests that if we do have a correction, that correction might be potentially larger than we might expect. So I would not be complacent about volatility going into 2026.
Equities, especially the Asian markets, including China tech, is our most and I would say most attractive and highest conviction call.
Well, I remain quite positive still on the Chinese equities because they are actually the least exposed to the US AI tech, and they are having very different drivers for the equity market.
You might want to look beyond AI as a structural theme. There is the financial themes as well. With deregulation, we don't talk about it enough, but we do think that it's going to be quite critical.
AI has stalled out in the last couple of days. So I think you all have to have in a portfolio different ideas. And so I am a believer that the financials, they've had a great year, but I think it's only getting started.
Welcome back. You're still watching Insight, and those were some of our guests sharing their investment outlook for 2026. Well, let's take a look at how we're doing in the final days of 2025. We've already closed here in Australia. The ASX having an early session, back again on Monday now. The rest of the major markets having a very quiet Christmas Eve. The Nikkei looking pretty flat at the moment, as is the Kospi. We've got the Indian rupee still floating floating just below that 90 rupee to the dollar level. Gold, once again, the story of the hour, though. It did briefly cross the $4,500 an ounce level, now just hovering below that. Silver has had an absolutely phenomenal year, better by well over 100% over year to date. Right now, $72.29 an ounce. And some of the action that we've seen here today also been helped along by a very strong third quarter GDP print out of the US, handily beating expectations. And President Trump is crediting his tariff policy for those better than expected US GDP numbers for the third quarter. In a Truth Social post, he said the US economy, in his own words, will only get better. Now, when Donald Trump rolled out global tariffs back in April, economists braced for the worst. Since then, a lot has happened, but the sky is yet to fall. So were the experts wrong, or is it just too early to tell? Our team at Bloomberg Intelligence takes a closer look.
Credit where credit's due, President Trump made a big bet that the US had a magnetic appeal, and that would enable him to get a better deal from US trade partners and companies that want to do business in the United States. On the evidence of the last few months, that bet is playing out pretty nicely. Economists don't agree on much. One thing they do agree on is that free trade is good and that tariffs are bad. For a moment, Trump escalated US tariffs on China all the way to 125%. If you plugged the US tariffs into a model of the global economy, what it said was that there was going to be a really significant drag on growth, and there was also going to be a significant upward impulse to prices. But when we look at what's happened to inflation over the summer, it's not come down, but it's not come up either. Why is that? It's because US importers and foreign exporters saw the Trump tariffs coming, and they rushed to front load shipping to the United States before the tariffs could come into force. One thing that's happened is that we've gone from a lot of unexpected bad news concentrated on a single day to a series of country-by-country deals. There's something of a Swiss cheese of exemptions and carve-outs. The trade war is a drag, but it's not the only thing which is happening. We've got tax cuts with Trump's one big beautiful bill, and we've got a bonfire of regulations which is stoking the animal spirits of US businesses. We've also got the artificial intelligence boom and a huge amount of investment going into data centers. Tariffs are having an effect. China's exports to the United States are way down relative to the historical trend. So, who pays for the cost of tariffs? Despite his well-known love of gold, the president is not an alchemist. He can't make something from nothing. That money has to come from somewhere. All of the evidence so far suggests that in the end, the bulk of it is going to come from US businesses and US households.
And if you want to watch the full version of that report from Bloomberg Originals, you can go to their YouTube channel. It's also available on the terminal and on Bloomberg.com. Well, tech and commodities are fueling a Santa Claus rally as the trading year winds down. Stock futures, though, have started to go quiet. Let's bring in senior Asia equities reporter Abhishek Vishnoi. So, Abhishek, why is everything rallying, and what propelled gold above $4,500 an ounce, and what's that going to mean for the dollar and stocks?
Yeah, I mean, it's a bit of a seasonal cheer into the year end that's helping, assets across the board. Mostly commodities today. Gold has rallied, like I said, above $4,500. We've seen platinum hitting a new record. That optimism is also going in the direction of what it means for the dollar, which means a weaker dollar, and therefore some of the equity markets enjoyed a pretty nice first half of current session. the gains have sort of petering out right now, and that's largely because there has been a little bit of FX intervention in some markets, and that sort of signaling might be positive for the short term, but for the longer term it isn't, and flows become fragile. So we are seeing a little bit of profit taking on that trigger in some of those markets, and that's why US futures have also trickled down a little bit. But there is a lot of optimism because markets had shrugged off the weak GDP print that had come in from the US, and US has is planning to hold off on any sort of chip tariff on China, so that's also a bit of positive that we are seeing in today's session.
So we've seen a bit of currency intervention from some Asian central banks, including Japan and Korea. What's this implying for risk assets?
Well, it's a short-term support right now, but as you can see in the equity markets, it becomes a signaling mechanism for the medium to long term as well, and therefore we are seeing some positions being paired, some concerns about policy tightening risk, and how it may play out in terms of equity, especially. There might be divergence between local-oriented stocks, let's say like banks, versus exporters. So all in all, it works out in the short term, but flows become fickle when intervention happens too fast, too soon, or a lot of time. So it all depends on how investors sort of perceive this in terms of credibility or credible action from central banks. So far, it looks like they have not made up their mind in terms of whether this is credible enough and well needed, and therefore we are seeing a little bit of profit taking happening in some of those markets.
All right, senior Asia equities reporter Abhishek Vishnoi there. Well, let's get some more market insights now with Ecaterina Bigos, CIO of Asia ex-Japan Core Investment at AXA Investment Managers. Ecaterina, thanks so much for joining us today. And I just would like to start, if we can, with your view on what the next moves are going to be for the Fed in 2026, because we've got a few competing forces here as usual. Really strong GDP numbers, a question mark over jobs, sticky inflation, and also lingering questions over Fed independence. So when's the next live meeting, or could we be kept waiting a while?
Well, I think it's fair to say we're starting 2026 with, I would say, easier financial conditions. And if you look at the last meeting, Jerome Powell certainly has signaled that they're somewhere around the high end of the range of neutral. I guess neutral is when the economy is not too hot, not too cold. So again, that signal acted in some way as a fairly dovish or constructive view to say that we're on a path to have that dovish bias, so we'll act based on the data, but it hasn't acted too hawkishly. So I think, as you said earlier, we have to look at the data. So ultimately, the move will be very much aligned, or at least considering what is happening with the job market, what is happening with growth, and certainly what is with inflation. We're coming in 2026 with a fairly resilient, as you say, growth trajectory. Inflation that actually surprised on the downside, away from kind of the potential volatility or impact from tariffs. I think Fed seems or deems the inflation to be transitory, and I think when you look at the job market, I think this is where the biggest concern is. The data has been quite conflicting of where the job market is in the U.S., and it's fair to say that the Fed is certainly going to pay a lot more attention of what's happening in that space and support the job market if it needs to be.
Well, there is a little bit of consensus from the market on this. There is an expectation we'll get 2 cuts in 2026. There is also an expectation we're going to see a weaker US dollar as well. So with that in mind, how appealing does emerging Asia look to you at the moment?
Well, I think that for the emerging Asia, obviously a weaker dollar certainly will be positive. But I think and the Fed obviously being dovish or dovish right gives the central banks in Asia probably a little bit more room. But I would say there are internal dynamics within Asia that certainly needs to be taken into account how much they can move right in the monetary policy everywhere from India, Korea. There are obviously home dynamics that restrict that maneuvering. So Fed doesn't matter so much now in 2026 2026. I think it mattered in 2025. 26 is going to be a lot more about home dynamics. And then when it comes to drivers of growth, certainly the AI cycle has supported, I would say, if you call them North Asia, so if you look at Taiwan, Korea, Japan as well, has supported certainly the growth trajectory. But if you take away the AI, it hasn't been a strong recovery in growth. The consumption has been a little bit more subdued, and certainly a lot of focus will be rewiring back and getting that consumer back to support the growth in 2025. So certainly a realignment of the growth drivers will be critical for Asian economies in 2026.
Yeah, in terms of the AI story around North Asia, I mean, the Kospi's just had an absolutely banner year and really being driven by those two big tech names, Samsung and SK Hynix. Do you see this trend continuing into 2026, or do you smell a little bit of a whiff of bubble risk around AI?
Look, and we stay constructive on AI. Obviously, the AI is a theme that is going to stay with us. I mean, just the question that I would ask is, like, can you imagine from here onwards the world without AI? AI is everywhere in some degree. Again, it hasn't. The biggest question for investor is not whatever the AI is staying. The question is, how do companies that deploy significant amount of capital into the AI are looking to monetize, and how they're monetizing that capex expenditure that they put in place. And I think that's where the amount of volatility and uncertainty is going to be in 2026, understanding, calibrating that trajectory of monetization. And with regards to the deployment of capital into that capital expansion and driving the AI story, it's going to stay, I would say, present, again, potentially with some adjustments. So certainly the story of AI is here to stay. Whatever we're going to see, a re-rating of the same magnitude, the valuations are fairly stretched in companies that you mentioned. So again, we need to pay attention to a combination of a structural driver of growth, which is AI, and certainly where the valuations stand for some of those companies.
In terms of AI, what are you looking at in terms of China allocation, where the story heads there in the coming year?
For China, obviously, with the DeepSeek, China is driving its own narrative around the AI. And obviously, the DeepSeek is an open source model. The different market participants in China have adopted the model a lot more aggressively than I would say what is done in the US. So the pace of that adoption is faster because, again, it's an open-end model. And I would say, by and large, it's still very much going to stay a China story when it comes to China AI development. And the ramifications for China is certainly their own companies that are going to benefit from adopting AI, increasing productivity, but also their own supply chain, which China increasingly is leaning on, creating that self-sufficiency when it comes to that technological advancement.
Do you see AI potentially replacing property as a driver of China's economy?
That is no, I mean, property was a significant driver of GDP growth for China. We've done actually analysis and we look at the broader kind of tech over the last couple of years. Again, AI is not just the entire tech, but again, it's hard to break down now and separate them. It only contributed about 0.6% of GDP. So again, it's still not a significant driver of growth. It's creating a lot of excitement. It's creating a lot of potential. But don't forget that the equity markets in China has been the rally has been very narrow. The growth drivers are still very much the ones that have been historically. So China has leaned a lot more this year on the exports, which is a bigger contributor to growth. They are increasingly still leaning on investment. They're moving away from low-end investment to a lot of, I would say, advanced manufacturing type of investment, tech innovation. So certainly they're shifting the gear, but they're still leaning on the same drivers of growth they've done historically. The key for China, of course, is, as we go into 2026, is that they need to drive a larger part of the economic growth from inward demand. So again, China consuming more of what it produces is going to be critical for 2026, but also beyond. So again, a structural shift away from kind of being the engine of production and manufacturing to consuming a lot more what they're producing.
I'm wondering if you can give us your sense of some of the currency movements we've seen as well, because we were talking a moment ago about dollar weakness as being a theme heading into next year, but you can't just make that as a blanket statement, because we're also seeing yen weakness, we're seeing weakness in the Korean won as well, and just today we've had a joint text message from the Bank of Korea and the Ministry of Finance moving to support the won, and we're seeing some dramatic moves in that currency now. So what's your outlook for some of these Asian currencies that are looking a little on the weak side, and what's fair value for the yen and the won?
Look, I think it's one point that, again, I'm not a FX strategist to break it down, but I'll just give you a little bit of insight into what are the dynamics that are happening in Japan and has led to, I would say, decoupling of the actions of BOJ to what the currency should have done, right? And again, it's been a big surprise on Friday when the BOJ has increased rates. We actually have seen a yen weakening. And some of the narratives around it is that a large part of the investors, whatever that's institutional or retail in Japan, they're still leaning to global for deployment of capital. You look at pension funds, they're still buying a lot of the foreign bonds, particularly U.S. bonds. And if you look at the retail, a large portion of retail investors are still investing globally rather than investing onshore at home. Then there's, of course, the foreign investors have allocated into Japan, but they've hedged the currency risk, and which is acted as a carry. So again, they have different confluent factors that has led to that weakness. But I think if you look in 2026, what is important for Japan as well is to shift a little bit, have a strategic rise and desire for, let's say, some of that flow to stay back home. Again, create a little bit more security around the growth drivers, not coming just out of the engine of exports, but also being a lot more home drivers. So nourishing some of the driving forces of growth that are home built, that the investors stay a lot more home than abroad. Again, that's a part that is going to drive some of the strength of the currency. And certainly the monetary policy will have an element of it as well. And again, the view is that Bank of Japan will move in 2026. Again, the view diverges to the timing and when, accounting for still kind of fragile growth, if you might say, for Japan that need to account for.
Well, Ecaterina, as the year winds down, we are seeing pretty much in everything rally. Equities higher, precious metals higher, even oil after having a rough year catching a bid. But when you look at risks in the market, is there anything that worries you, and are there any pockets of overvaluation?
Look, I think for us, and I take a slightly different angle in terms of the risks. We know kind of the macroeconomic things. Everybody's looking at policy. Everybody's looking at inflation and so on and so forth. But in terms of, I would say, if I had to give a helicopter view in terms of what the risks for the key markets that we discussed, I would say for the U.S., the biggest opportunity and the biggest risk is reindustrialization of U.S. What does it mean? U.S. is aiming to produce a lot more than it consumes. So steadily becoming a lot bigger force in manufacturing will be a key opportunity for U.S. over longer term and certainly in 2026. And we've seen already emergence of that reindustrialization through the AI CapEx cycle expenditure, right? So, and I think this is key to observe as we look in 2026. So certainly failure for U.S. to take a lot more of that manufacturing home certainly will be a risk. In Japan, I talked about, again, a strategic rise of Japan and increasing strategic autonomy, again, the sensitivities around energy sufficiency for Japan and creating a much more domestic economy. And when it comes to Europe, we need to look at places like addressing competitiveness. So again, Europe has a lot of opportunity, but we'll have to look at some of the kind of the risks as well.
All right, Ecaterina Bigos of AXA Investment Managers, thanks so much for joining us today. Still to come, Wall Street giant Jane Street said to have hired lobbyists as regulators in India close in on a high-stakes investigation. This is Bloomberg. All right, Bloomberg has learned Jane Street is hiring lobbyists for the first time in 20 years. Sources say top executives have also been meeting with lawmakers to explain their business. Bloomberg Asia Equities editor CJ Chakraborty joins us now. So, CJ, why the lobbyists? Why the sudden need?
Well, at this point of time, Paul, it seems that Jane Street is actively talking to lawmakers across Washington to make them familiar with what the company does, what it trades in, how it has been raking in record trading revenue throughout the past 2 years now, and also talk about the ongoing probe in India. They want to familiarize U.S. lawmakers about what has taken place in India following the local regulators' bombshell order back in July, interim order back in July, which raised allegations of market manipulation against the U.S. proprietary trading firm. And that has largely been the objective of many of these meetings.
So tell us more about how that probe in India is progressing, what it's about, and how hiring U.S. lobbyists could potentially help.
Well, Paul, Bloomberg, through his reporting, has learned that that probe is broadly edging closer to wrapping up, with the regulator also investigating an additional strategy that was not part of its interim order back in July that they feel could be manipulative. The strategy is popularly known among traders as a short straddle, which involves the selling of put and call options at the same strike price of an index. And there, the regulators allege that Jane Street's activities in the cash market particularly was so large and having such a big impact on the prices that they manipulated, allegedly, the index to close in its favor and therefore reaping rewards through a strategy.
All right, Bloomberg Asia Equities Editor CJ Chakraborty there. Thanks for joining us. Let's take a look at how Asia benchmarks are tracking. We've already got Australia closed, heading off early for the Christmas break. Elsewhere, it's pretty quiet, really. The MSCI Asia Pacific better by 1/5%, but the Nikkei pretty much flat right now, as is the Kospi, as you might expect on Christmas Eve. A lot of the action, though, we're seeing is happening in the currency space, particularly the Korean won. Some of the biggest moves we've seen for quite some time. The won strengthening after authorities said excessive weakness in the currency isn't desirable, and foreign exchange markets will soon see the government's strong determination. And adding weight to that, the message came via joint text message from the Ministry of Finance and the Bank of Korea. All right, still to come. Vietnam's Communist Party preparing for a major leadership decision in a move that could reshape the country's political structure and its reform agenda. That story up next. This is Bloomberg. Welcome back. You're watching Insights. Here are some of the stories we're watching. Nearly half a dozen tankers laden with crude have departed from Venezuela's coast despite increased pressure from the US. Data from maritime intelligence firm Kepler shows that most of the tankers are heading to Washington, and at least half of them are chartered by Chevron. This comes as the Trump administration intensifies efforts to curb Venezuela's oil revenue by targeting sanctioned vessels. The U.S. Supreme Court has refused to let President Trump deploy National Guard troops in Chicago. A majority of judges ruled that the administration failed to identify a source of authority that would allow the military to execute the laws. The move is a setback to Trump's drive to use the military in cities across the country, including New Orleans, where authorities have just deployed 350 troops. Myanmar's ruling military junta is pressing ahead with elections this Sunday. It's first since seizing power in a 2021 coup. The army hopes the ballot will restore legitimacy after clawing back some territory from rebels. Observers, though, call the vote a sham, with the military-controlled ballot expected to favour the junta-aligned Union Solidarity and Development Party. Well, Bloomberg has learned Vietnam's Communist Party will nominate General Secretary To Lam to stay in the top job, and that would pave the way for him to push on with a reform program. Vietnam Bureau Chief Francesca Stevens joins us now from Hanoi. So, Francesca, what's happening with the party leadership?
Yeah, that's right, Paul. The big twice-a-decade Communist Party Congress gets underway next month here in Hanoi, which is where the nation's senior leadership will be elected for the next 5 years. And ahead of that, the Party's top decision-making body, the Central Committee, has been meeting to decide on the candidates to nominate for it. Now, this is a secret closed-door meeting, but sources told us that the current party chief, To Lam, secured enough backing to get the nomination for the top job. What we also understand is that for the first time in the modern era, party chief will also be put forward for the presidency. Now, this would be a rare and significant move that would concentrate both positions in the hands of one leader and would be a sign of Lam's increasing grip on power. Now, this still needs to secure support at the Congress in January, and for the presidency, this also needs parliamentary approval. But what it shows is that at this stage, To Lam is very much on course for a full 5-year term as General Secretary.
Okay, so if he gets that full 5-year term and holds that very powerful dual role, what's it going to mean for reform and Vietnam's economy?
Yeah, well, since To Lam took over as party chief in August 2024, he has pushed through some of the most dramatic reforms seen here in decades. This has included merging ministries, slashing the size of the bureaucracy, getting rid of an entire tier of local government, and reducing the number of provinces by half. Now, a number of key resolutions have also been passed, including one to elevate the private sector, which has drawn particular attention in an economy long dominated by state-owned companies. All these changes have been pitched as essential medicine to reduce red tape and cut costs. And while investors have welcomed the reforms, detractors have suggested that Vietnam under To Lam is moving too far too fast. Still, the government has set the ambitious goal of at least 10% annual growth over the next 5 years, so more reforms could well be ahead.
All right, Bloomberg's Vietnam Bureau Chief Francisca Stevens there. Well, let's get some more on the geopolitical scene, particularly around Southeast Asia, with Bridget Welsh, who analyses Southeast Asian politics. She's an honorary research associate at University of Nottingham Asia Research Institute, Malaysia. Bridget, thanks so much for joining us today. And Vietnam feels like a good place to start, considering today's news. Can you give us a sense of how unusual and how important it is that To Lam would potentially hold these dual roles of Communist Party General Secretary and President, and what it's going to mean for the reform process?
So, in fact, To Lam has had gaining power for the last year, and the reforms reflect that as he's been consolidating leadership. So, in some ways, the party Congress is a reflection of what he's been doing for many, many months now. It's different because what's happened is that he's purged many other factions from the party leadership. And that has basically really been away from the norm in Vietnam politics, because there's usually been an accommodation of different groups. And in that process, he's really put his particular faction, which has been driven on issues of security as well as on issues of economy, very much at the top. And he's made leadership much more around him personally. And I think in this ways, this is quite unique. Personalities are important in Vietnam, but they're not as critical in the way that To Lam's leadership has become so, much more consolidated around him. For the reform process, you can see that they're really trying to introduce very important structural, economic, political reforms as a combination. And so this aim to try to bring in more capital to drive the private sector faster is very pivotal, because this government relies heavily on economic legitimacy in order to be able to sustain itself. And that's very much how To Lam has actually been able to position himself as well as controlling the security apparatus of the state.
Yeah, well, that was a point that our Vietnam bureau chief was making, and investors have welcomed this news. But are there risks here as well, particularly around concentrating so much power in one person?
Indeed. And I think part of that is about centralization. Part of that is also about a sense of exclusion, because Vietnam has always had a certain degree of inclusion of the different party factions. Now that has no longer been the case. And then there's also this issues of high expectations and meeting those expectations. So Vietnam has performed. It's the best performer for the economy in the region. Received 8% growth in recent numbers coming out last year, or earlier this year. What we see is a situation, however, that it's still the goals are very high, and to be able to maintain that, I think, is going to be a very big challenge, especially where we're in a region where we still have issues of uncertainty, a lot of economic shocks that have really had impact on the region, particularly also the tariffs.
Bridget, I also want to get your view on the border conflict, low-level war, I guess you'd call it, going on at the moment between Thailand and Cambodia. What are your expectations around the hopes for a ceasefire next year, and how soon could we potentially see one?
Well, one always has to try to be optimistic about these things. But I think what we've learned when we push a peace agreement, when there really isn't adequate resolution of the issues or adequate buy-in, then that peace agreement falls apart. I think the week so far has been a positive one in the sense that the talks in Kuala Lumpur really have basically restarted talks. There's been discussion now about whether or not the venue should be in Thailand or should it be in a more neutral location. This is yet to be fully resolved. But I think the fact that there is this wanting to re-engage in conversations is a very important one. But given that the fact that Thailand is going to hold a general election in early February, my projection is that there are very limited political reasons for you to have a resolution to this issue, especially when you rely heavily on nationalism. And both sides, while they're willing to engage in talks, and there's been pressure from the United States and from China and from the ASEAN to try to encourage this, the fact of the matter is that the underlying issues of landmines, of territory, as well as kind of nationalist sentiments are still very high. And so I think it's going to be, at least in the short term, a slow process. And until the election in Thailand is resolved, we're not likely to have anything meaningful that is very substantive. We may reach a ceasefire, but so far that has not yet happened.
Yeah, well, I want to talk about the upcoming election in Thailand in a moment, but just sticking with the border dispute for now. I mean, that issue is a very old one. It dates all the way back to arbitrary lines drawn on a map during the French colonial era. So how does one achieve a lasting peace?
Well, not easily. I think, and the thing is that the current war has also made this issue much more difficult because Thailand has been gaining more territory. So there's been pushing into the boundary areas, and Cambodia has engaged in a kind of landmine and more hidden offenses and responses. So in this regard, I think it's going to be challenging. The only way that I think this is going to be sustainable is to a certain degree to bring in alternative actors as well, to try to build a peace constituency. Almost 1 million people have been displaced from these border areas. And I think that the impact on lives and on society of this, what is seen as a border war, but it is quite significant in terms of numbers, and it is also significant in terms of the impact on the economy. There needs to be a widening of the different discussions, but that can only happen after there is a ceasefire. And right now, the Thai military is vested in a nationalist agenda and hoping to bring in a nationalist government back in and hold it in Thailand. So I think it's going to take more. It's going to take something more fundamental than external pressure. You need more pressures from within these societies. And right now, that tension is to fight as opposed to step back.
Yeah, well, let's talk about the election then. I mean, Prime Minister Anutin probably in the box seat here heading into that snap poll. Aside from the Thai-Cambodia conflict, though, what are the implications of a potential Anutin victory for the Thai economy and for foreign policy?
Well, there's two sides of it. Right? One, in terms of the domestic politics, the projection is that this would basically create a certain degree of stability it's because he's a conservative party. What we can see is that a conservative party would be able to work with the military and the royalty. However, I think that the public voting has been with demands for more change. and demands for more liberal alternatives and wanting to have a different power arrangement. And so I think right now it's almost too soon to see what's going to be the implication if the incumbent stays, because right now he's a minority government dependent on the other parties that are also allowing for stability and pushing for these elections to happen. And voting in Thailand has got multiple different fragmented sources. You're likely to get, no matter who comes in, another form of elite deal making among different coalition players. And so this question will be how many, who are they, how do they win on the ground? I think that the foreign policy issues, Thailand has been always very adept at managing different players, the U.S. and China. We've seen a move towards China, but recently there's been involvement with the United States, particularly in terms of trying to manage the scam centers, part of which is one of the underlying issues in the Thailand-Cambodia war. So I would say that I think that we're going to continue to see a kind of adept balancing. So it's not going to be a more fundamental shift in the foreign policy arena. I think what's interesting to see, however, at the domestic side is who are the players and whether or not liberal forces will continue to win political support or whether or not conservative forces will be able to garner more. If we look at recent Thai elections that have been open and fair, we can see that conservative forces do not fare as well.
Just finally, as we mentioned a few moments ago, there is also an election coming up in Myanmar, military-controlled elections in 2026. I mean, how credible and legitimate do you think this poll is?
So I would say I wouldn't even use the word elections, but if we have to use the word elections, we talk about it as a sham election. It's a political exercise aiming to try to legitimize. But more than half the country is not holding their elections because of either the conflict. So even of the different villages that the government and wards that the government has said, or at least the junta has said, that they would be conducting elections, there are many of them where they actually aren't able to do so. And this is a kind of an attempt to sort of repeat what happened in 2010, which is to try to kind of have a road plan to kind of create external legitimacy. But it's under very difficult and very different circumstances where the country, large sections of the country are controlled by opposition and ethnic armed group forces. We see a situation where the junta has been engaged in serious political and pre-election violence, basically clearing different areas in order to be able to conduct the polls. And I think that the question will be whether or not people will participate. And most people say that this exercise will result in what we expect, which is that a rigged election, a rigged exercise. So in this regard, I think this is a very troubling type of development, one that the international community is watching carefully to understand and to appreciate the type of mechanisms that the junta is trying to keep in power.
All right, Bridget Welsh from the Asia Research Institute, Malaysia. Thanks so much for joining us today. Coming up, influencer Logan Paul set to sell his rare Pokémon card. This is the one that he bought for $5 million, about that, in 2021. We'll have details of that next. This is Bloomberg. Welcome back. You're watching Insight. Now, if anyone's looking for some last-minute gift ideas this holiday season, here's one. You could consider buying a rare Pokémon card from none other than Logan Paul. The WWE star and influencer bought the item for a little more than $5 million in 2021. Paul accepted a $2.5 million advance from Ken Golden to sell the card. The CEO of Golden Auctions says it could sell for more than double after being featured on his Netflix show.
I love the show, King of Collectibles, The Golden Touch. This is our third season, launched today. It's, takes you into the incredible world of collectibles, the value of the items, the history behind it, the story of the chase, the excitement, and also the personalities that collect the items, that buy the items, and why collectibles are so incredibly important. It's a fast-paced show, and I love doing it. I hope I'm doing it 10 years from now.
When you talk about personalities, no one's a bigger personality than Logan Paul. You seem to be clutching your chest right now. Is that because you're wearing a very expensive jacket?
Yeah, well, yeah, the jacket is expensive, but that's neither here nor there. No, it's because I have the most expensive Pokemon card around my neck, and let's see it. Superman. Oh my God. The one-of-one PSA 10 Pikachu Illustrator that is on season 3 of Ken's show.
The most coveted card in the world.
Absolutely. So those folks who aren't Pokemon experts, I mean, you famously bought this card back in 2021, the most expensive one ever. And this is a rarity. I mean, these cards weren't really sold. They were just kind of given out, right? And at some point, you managed to get a hold of one of the few, not only just intact ones, but I'm pretty sure this is the highest rated one out there, too.
Yeah, it's the only one in the world. It's a PSA 10, meaning it's perfect.
Yeah.
And like I said, it's one of one. Like you said, it was one of 39 copies handed out in 1998 for a Pokemon illustration contest. So this card couldn't be bought. It was earned, which is part of the reason why the lore contributes to such a high value for the card.
When you paid what, by most reports, it's upwards of $5 million for this. There are a lot of people that said you are an idiot.
Yes.
Like, what is he doing? Who would pay that much for a card? Now, I'm told that you're actually willing to put this back onto the market. You think you're going to get more than the $5.3 million that you paid for it?
Look, that's honestly always the goal, right? Yeah. But I actually say willing isn't a great word. I had to be convinced to put this card at auction. Ken has chased me for years trying to convince me to sell the card. And let's be honest, the Pokemon market is as hot as it's ever been right now. And those people who thought I was an idiot, I think I'm the one laughing in their face now, because Pokemon has delivered higher returns than the stock market in the past 20 years by upwards of 3,000%. And so, while I think this will probably go for more than I bought it for, it's an auction, but it is the best card in the world. There's nothing like it, and it's a piece of history now. I wore it out to my WrestleMania debut. It's on Ken's Netflix show, and I think we're excited to see what it can go for.
And it's funny you bring it up when we talk about this idea of collecting. Let's start with art, right? Yeah. That was what, if you had a lot of money, you bought your Monets, your Jackson Pollocks, things like that. There was sort of this wave a few years ago of this younger generation coming in, Ken, as you know, that were much more interested in things like Pokemon cards, Magic the Gathering cards, sports memorabilia. And a lot of people kind of scratch their heads, what's that really worth? Comic books, hip-hop memorabilia. It's really expanded. Talk about how that's expanded your business away from the more traditional collectibles that we think about.
Sure. What you have to realize is that collectibles as a category right now is an asset class. It is an alternative asset class. And while maybe in 100 years ago and also in the 1930s, 40s, 50s, 60s, collecting art, whether it was Picasso, whether it was Renoir, whether it was Monet, Warhol, to go more recent, was what the quote super rich did, and that was the traditional collectibles. People who grew up worshiping athletes, and people of a little younger than me who grew up on Pokémon, which has its 30th anniversary in February this year, they did not grow up dreaming about owning a big art collection. And as they get into their 30s and 40s and 50s and late 20s, they have a lot of money. So to them, owning the best of the best, whether it's a Pokemon card, whether it's a game-used jersey, whether it's a sports card, that is what they aspire to be. And that is how we can see something like a basketball card with pictures of Michael Jordan and Kobe Bryant sell for $12.5 million.
Yeah.
That's how we can see a jersey worn by Babe Ruth sell for $24 million. That's how I can sell a baseball that was hit by Shohei Ohtani for $4.4 million, and that's how we can see, the Pokemon Illustrator, the single best card out of the entire Pokemon genre, which is the world's biggest franchise, sell for 8 figures.
All right, season 3 is out now, or coming out now. What else is next for you and Logan?
Well, we have as people will find out by watching the show, we have planned together what we believe will be the biggest TCG trading card game auction in history.
Okay.
The Illustrator is going to be the anchor, and there's going to be millions and millions and millions of other dollars, of other items, Pokémon, Magic the Gathering, and similar items. And we're going to have the auction. It's going to launch in January. It's going to close February 15th, and timing it for the 30th anniversary of Pokémon. And that's something that, we're looking. My worst case scenario on that is $15 million. I'd love to do a $25 or $30 million auction with that, and that's really, to me, a big event for the industry. Mm-hmm. I can tell you what's happening for the industry right now. Over the past 6 weeks, I've been contacted by multiple firms that are either in existence or just starting up or want to start up to have, basically funds dedicated to collectibles.
When you say funds, like
a gold fund or a crypto fund, but a collectible fund. And whether it's $50 million or $250 million.
Why haven't we seen that? I mean, or something like even an ETF or something.
Well, that's exactly what people are looking to do for now. There is one company out there that is doing it. They're doing it solely with basketball cards. These people want to do a more broader basket, and as probably hobby-wise the most well-known guy. They're coming to me and asking for advice, but I think that is really going to take the market to the next level.
And you think that's possible? I mean, with regards to the regulations, you think they would sign off on it?
There's one successful fund that's operating right now, and but it's very private, very closely held.
Sure.
But I do think that there's so much opportunity. I expect that to happen.
Now, before we leave you, let's take a look at how some of these key these precious metals are tracking. The impressive rally just rolls on. Gold looking close to recovering that $4,500 an ounce level, and the silver rally pushing higher. Asia FX also in focus after Korea vowed strong determination over its currency, the Korean won rallying the most in 6 months. And that is it for Insights. Horizons Middle East and Africa up next. This is Bloomberg.